Thank you, Bob. And just before I do start, I'd just like to thank you for your hospitality. Thanks for the opportunity to come down to Christchurch and present to you. I've really enjoyed my time so far, so thanks for your efforts there, Bob. Okay, so just a bit of background on this research. This research started as a research project with an honours student that I have, and unfortunately the student didn't do such a great job, which is why their name isn't on the paper, and one of my colleagues in Auckland's name is. Unfortunately, we had to pretty much redo everything from scratch, and actually came up with some quite different results to what they found. So the basic question that we're looking at today is a very, very simple question. The question being, do positive returns in January imply positive returns for the remaining 11 months of the year? And conversely, if the market is down in January, does that suggest that the market will be down for the next 11 months of the year? And when I'm talking about market, I'm talking about the stock market. This is a theory that has been applied to the US equity market in the first instance. So just to put some numbers around this, for instance, in 2006, the US stock market, proxied here by the S&P 500, went up 3% in January. For the remaining 11 months of the year, it went up another 13%. So advocates of the January Barometer as a prediction tool would put a tick next to the January Barometer for 2006. The return was positive in January, and for the next 11 months, the market also went up. Similarly, in February, in 2007, January return again positive, and the next 11 months of the year there was a positive return. So again, advocates of the January Barometer would say, well, it worked again. However, in 2008, we started the year with a big decline in January. So clearly, proponents of the January Barometer would be suggesting the February to December period in 2008 will be a negative period. So that's the January Barometer. What do practitioners say about the January Barometer? Well, actually, practitioners that are quoted in the media like this a lot. One quote up here from Yale Hirsch. Yale Hirsch writes each year a publication called the Stock Trader's Almanac. And within that almanac is all sorts of weird and wonderful ways of supposedly making money on the stock market. And you'll see in this particular quote here, back in the 70s, that he points out that by his records, the January Barometer has proved to be correct in 20 of the last 24 years. So he makes the point that it seems to have an incredibly good hit rate as a prediction tool. Just some other evidence of what practitioners are saying about this, just a quick search and on the Newswires for stories that have a headline with the January Barometer in it. And just a very brief selection. In 2007, January Barometer bodes well for 2007. Rosy start seen as a reliably good sign for investors. So basically every January, if you look at Bloomberg, look at Business Week, look at the business publications, people are making forecasts for the year based on what they're seeing in January. Now, it's all very well that the investment community thinks they've latched on to some sort of money-making technique, but we know through history that there's been all sorts of inefficiencies claimed in the market, all sorts of ways to make money claimed, but they very rarely stand up to any rigorous statistical analysis. So practitioners say, yes, the January Barometer works. The question is, what does the academic literature say about the January Barometer? What evidence is there? Well, what really aroused my interest in the January Barometer was a paper that came out in Journal of Financial Economics in 2006. At least that's when it was published. And the three authors, Cooper McConnell and their co-author, subjected the January Barometer to a barrage of statistical tests. All sorts... Oh, sorry?
I know nothing about this literature, but are they comparing the January Barometer to like a February or a March Barometer, or are they just looking to see whether only January predicts?
Yeah, it's a very good question, and no, part of the analysis is to say, does a February barometer work, does a March barometer work, and what they show is that January stands alone as a prediction month. So that was part of their robustness test, and we'll look at some of the evidence on that in just a couple of slides. So they subjected it to all the normal robustness tests. Is this just picking up a risk? Is there some sort of strange time-varying risk cycle throughout markets that is just being proxied by the January Barometer? Is it, sorry?
In New Zealand, the fiscal year doesn't start
No, April's a more traditional start for the fiscal year in New Zealand. Yeah, well, that's one of the things that we look at, and I've done some work around that fiscal year argument that's not in the paper. I just did it last week, and I'll discuss that at the end because I think that actually goes some way to explaining what we're seeing in the US. Okay, so the first paper finds, yes, the January Barometer seems to be very robust. Journal of Financial Economics published that. Another paper that was really done at the same time, simultaneously, find pretty much the same results. They look at a similar period and not surprisingly, they find similar results. That second paper ends up in Journal of Investing, didn't subject the January Barometer to nearly the same robustness tests that the first paper did. So, based on that brief evidence from the academic community, I suppose we'd have to say, well, academics say yes as well. The two papers that have studied the January Barometer say we don't have a reason behind its existence, but we can't refute the fact that January returns predict returns for the next 11 months of the year, or rather the sign of returns in January is an important prediction tool.
How does this distinguish from the turn of the year effect, that right at the beginning of January effect that sometimes you see in the literature?
Yep. So that being the theory that maybe the first 5 days. Right. Yeah. And what most people find is that is also a prediction tool, but it doesn't have the same power as the January Barometer. The January Barometer tends to subsume that, and it's a less noisy indicator, which I guess isn't surprising given that you've got the monthly returns rather than just the first 4 or 5 days. Yep.
In terms of converting that to making money, you can buy the S&P 500 futures, right?
Mm-hmm.
And do you find that when that instrument came out, that it all affects transaction costs and implementing that advice to make money? Does the introduction of that financial instrument seem to impact the barometer as an effective forecasting tool?
Yeah, it's a good point. It's something that I haven't studied extensively, but to the best of my knowledge, futures on the S&P 500, futures contracts have been available for quite a long time. What the more recent introduction that's made sort of index investing even more accessible is the introduction of exchange traded funds, so ETFs that you can just buy as a stock. So anybody with access to an online broker can buy an ETF on the S&P 500. And they were sort of introduced, or I think the ETF on the NASDAQ was introduced first, but in the last sort of 5 to 8 years. Now, it's a bit hard to say exactly what's happened because in the last 5 years, the January Barometer's maybe worked 3 out of the 5 or something. So it's hard to say exactly what impact that has had. But that leads nicely in. Oh, did you have a question?
Vanguard introduced an ETF in the S&P 500 about 10 years ago.
Okay, yes.
And the futures contract in the S&P 500 has been out for about 25 years.
25, yep.
Which, because I'm 56, 25 years ago.
Okay. Yeah. Sorry. No, the ETF. I meant the ETF was new. I was trying to make the point that the futures contract has actually been around for quite a while. Yeah.
See, for me, 25 years is
Oh, okay. I see your point. Sorry. Yeah, in the context of the study, I suppose. Yeah. So.
We'll benchmark all the results against your lifespan in the future.
So it's a very good point that you raised, Bob, about the transaction cost argument, because there's been a lot of so-called anomalies documented in the financial economics literature. And what is often found is that the supposed profitability is eroded by transaction costs or some other impediment to actually exploiting the anomaly. And I suppose this dovetails into Jensen's 1978 definition of market efficiency, the notion that maybe markets are inefficient to the point where the costs of exploiting the inefficiency equal the benefits, so there's no incentive to go about exploiting it. So a good example of that would be the momentum literature in finance. Momentum basically means buying stocks that have outperformed in the recent time period, short selling stocks that have underperformed, and replicating that process every month. Clearly huge transaction costs are incurred, so if you just study the raw data, yes, supposedly there is profits to be made, but when you carefully start considering the cost that you incur, it's very dubious as to what's left. So that's where the January Barometer is a little bit interesting, because we're not talking about a tool that requires frequent trading, are we? I mean, we're sort of saying one round trip every 11 or 12 months. You observe the January return, you either go long or short at the beginning of February, you hold that position for the remainder of the year. So on the face of it, we'll get to some of the numbers that the January Barometer produces shortly, but on the face of it, you'd sort of have to assume that transaction costs would have to be reasonably high to remove it. Yes.
You talk about the January will be broken up into small amounts, like
Mhm.
35 days,
Mhm.
and also whether there are any other months that work just as well.
Yes.
Presumably they've also looked at the January best predictor for the next 1 month, 2 months, 3 months up to 11. So if the January only worked for the next 6 months, then that's the 11 month works because it contains the first 6, or...
It's a very good point, and to the best of my knowledge that hasn't been looked at. That's something that we should look at. People have obviously tried to stay true to how practitioners have presented the January Barometer, but clearly to try and get an understanding as to the profile of returns throughout those 11 months is a good thing to do. So we will do that. Yep. Thank you. Yeah.
So, I mean, I don't know anything about this. This is the first time I've heard about the barometer. First, I thought we were going to be talking about the weather. But, so it seems that this January barometer is like a conventional wisdom, right?
Yes.
So, do investors actually say, you know, why they think that it works? Is it something like a self-fulfilling prophecy?
Yep. And we actually get to that point in a couple of slides. Do you mind if I just hold off and address it then? But yeah, we definitely reached that point. Did you have a point?
There's a much more part of those. Tax loss selling and dividends, which has nothing to do with behavior considerations.
And that's part of I want to link into that towards the end, because that's where my thinking is at the moment in terms of an explanation.
The small window then? If it's strictly a tax loss effect, I mean a tax selling, why wouldn't the turn of the year effect really be what's driving the whole thing?
Okay. I can cut straight to my ultimate conclusion.
Okay,
I'm happy to do that. Yeah. What's that, sorry?
Keep continuing.
Okay, so I'd like to suggest that I don't think transaction costs are likely to be the explanation. Maybe it's just data mining. I mean, if you torture the data long enough, usually something shows up. So maybe that's an explanation.
They will confess to some crime.
That's exactly right. I couldn't quite remember the exact quote there, but that's it. Maybe there's a risk-based explanation. Doesn't seem likely, but maybe we're just picking up some risk-based effect and would expect to be compensated with extra return for the risk that we're incurring. Maybe there's dummy variable persistence. Now, this is unique to the methodology that's used to assess the January Barometer, and I want to discuss that point in a lot more detail coming up. Maybe it's spurious for some other reason.
Are you suggesting that dummy variable persistence would be a spurious reason?
There's a paper that's come out in the Journal of Portfolio Management, and it studies the presidential cycle effect in the US. So there's a paper in Journal of Finance in 2003, I think, Santa Clara and Volkanov. And what they show is that the stock market tends to perform better under Democratic presidents than under Republican presidents. And they do that using monthly stock market data. So basically it's just a means test, I suppose, comparing the mean return for periods when there's a Democrat in office versus the mean return for periods when there's a Republican in office. And they subject it to a lot of robustness tests. I'm probably doing their methodology a bit of a disservice. But the fact is that they assess that using a dummy variable. So their dummy variable equals 1 if there's a Democrat in office in a particular month, 0 if there's a Republican in office. They just regress the return on that indicator variable. It's nothing to do with this barometer. Just what a subsequent study shows is that you've got a dummy variable that's highly persistent, because 4-year presidential term, monthly data, the minimum series of ones, if you like, is going to be 48. So if the president is changing every 4 years, you're going to have a dummy variable that has 48 ones, 48 zeros, 48 ones, and so on. And what they show is that just as having persistence in other regression contexts can lead to spurious results, equally with the dummy variable being highly persistent, that can lead to conclusions that they would claim aren't valid if you accounted for that. So given that that's established in the literature, we're just saying, okay, the first thing the referee's going to say is, dummy variable persistence, we already know about that. So we're just trying to address and placate that.
So what it comes down to is you're searching between, is there something underlying about January that carries on, that contains information that somehow hasn't been recognised by the market yet? That if you had that right-hand side variable, then you wouldn't need January.
Yep.
You don't need to bring it up. But then why have people noticed that January works and trade it out the data versus
Yeah, that's exactly right. Yeah. Do you have a comment or?
Dummy variable persistence effectively says that your dummy variable is edging into an I1 process. It is pretending to be I1. But the dependent variable returns on a market index. That is, we agree that's an I0 process. To regress an I0 and an I1, it tends to have a coefficient of 0, in which you tend not to reject it. You tend not to reject it, no effect. Dummy variable persistence.
It's not changing. It's not changing all the time. Why would it be I1?
That's if something doesn't, if something persists, it doesn't change, then it's masquerading as an I1. It is you're in the I more in the I1 camp than an I0 camp. The dependent variable is clearly in the I0 camp. It's an unbalanced regression. Unbalanced regressions tend to have the zero. By an unbalanced regression, the slope coefficients are biased to 0.
Okay, yeah. So you've got a far superior knowledge in this area to me. What we do is we run it using an adjustment for this dummy variable persistence, run it without the adjustment to see whether that's having an effect. And I suppose the reason that we do the dummy variable adjustment is more, maybe political reasons isn't the right word, but given that there is this paper out there that's shown it's had an effect somewhere else in finance, we say, okay, there's another robustness test that's just subject to that. Maybe that initial paper is without substance and we didn't need to worry, but as it turns out, it doesn't have a major bearing on our results either way. Okay, so what do we do? Well, we reconsider the US evidence. Firstly, we want to just check that our techniques get similar results as the initial papers in this area. And then we say, okay, well, if there's some sort of January barometer, surely it's reasonable to expect it to not just be a US phenomenon. One of the big things that's led to credibility being given to other effects in finance, such as momentum, excluding the transaction costs, is the fact that momentum doesn't just work in the US, where Jagadish and Tipman first showed it to work. Rather, it pretty much works in markets around the world. And there's reasons based on investor behaviour and so on that suggest that that should be pervasive. So we focus on the US and 23 other markets. We just use developed markets from within the based on Morgan Stanley's capital index definitions, mainly because they've got long series of data. And I should point out on this point that after writing this paper, we came to the knowledge that 2 other people are actually looking at the international evidence on the January Barometer as well. So there are other people looking into this at the very same time. And I'd like to suggest that we're sort of making some contributions beyond what they're doing, but we'll get to that later. Of course, I would say that, wouldn't I? So one of the big things is to account for risk. This whole notion of Jensen that maybe the costs offset the benefits of exploiting an anomaly. And in terms of costs, I'm thinking loosely here. So I'm thinking of direct transaction costs, but I'm also thinking of risk-based things. Maybe you're just picking up the fact that you're having to bear more risk, and therefore you would expect to be compensated. Now, one of the things that Farmer said in a pretty famous paper in 1998 that appeared in the Journal of Financial Economics is that we need to be very careful when we're looking at tests of so-called anomalies, so-called violations of market efficiency, because effectively we're conducting a joint test. We're conducting a test of the anomaly's ability to outperform the benchmark model, but implicit in that is that the benchmark model actually is a good representation of the underlying economic process. So effectively you're dealing with 2 nulls there. So as a result, people have started to question some of the common ways of adjusting for risk in the finance literature. Very common approach is the Farmer and French 3-factor model, so adjusting for market risk, size risk, and book-to-market equity risk. But people have started to show that actually size and book-to-market equity and even beta can be poor proxies for risk. So what we've done here is tried to come up with two benchmark models that make very few assumptions about the underlying returns process. So we've tried to be as loose as possible about imposing how the underlying economic process might work. So stochastic dominance, and then a manipulation-proof performance measure, which is just trying to extend the Sharpe ratio, really. So looking at how much return is being earned per unit of risk incurred. We account for dummy variable persistence and dummy and data mining bias as well. We consider time varying risk premia, and we also look at whether the January Barometer is consistent at the individual stock level. So this is something talking about the market as a whole, but we say, well, presumably you'd expect to see some sort of patterns within the stocks that comprise the market rather than something just showing up at the market level and not being prevalent at individual stocks. So enough of what we do. What do we actually find? Well, just some background on this table here. We've got the first four series are from 1940 to 2006. So we choose the same start point as previous authors in this area to try and ensure consistency. Now, EW is the equally weighted index of all stocks in the CRISP database. So effectively all stocks listed on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. So equally weighted CRISP stocks. VW is just value weighted. We consider just the raw returns from those stock indices, and we also consider the excess returns. So those first four series, 1940 to 2006. The last two series, 1970 to 2006. So we consider a more recent time. MSCI is the US index calculated by Morgan Stanley. So we consider the raw index and also excess returns. Now, what do the numbers represent? Well, the 14.09% there, that's the average 11-month return, so the average February through December return for years where there was a positive January. So in the 67-year period in our sample, 54 of those years there was a positive January. Following a positive January, on average, the 11-month return was 14%. Following a negative January, the 13 instances where that occurred, the 11-month return was negative 2.98%. So what we're effectively saying is there a statistically significant difference between the return following the 11-month return following positive Januaries and the 11-month return following negative Januaries? Can we conclude that January being a positive month gives a better indication about the future being positive than January being a negative month?
Why do you worry about positive versus negative, instead of whether there's, what the correlation between them? Obviously they would go the same direction, but, why not look at with a 2% return? What would 2% return?
Yeah, and we have considered that. And interestingly, the January Barometer makes no comment on that. So it's one of the interesting things. So if you saw a January return of 0.1%,
yeah, exactly.
It's suggesting that implies the same about the next 11 months as a January return of 10%, exactly. Which seems a bit nonsensical, which gets to some of the explanation about why I think the January Barometer appears to work but doesn't actually add much.
Is your data set the CRISP monthlies?
Yes.
Okay, and EW is the equally weighted.
Mm-hmm.
The equally weighted portfolio. VW is the value weighted.
Mm-hmm.
And minus or is minus the treasury bill rate.
Mm-hmm.
The return on the treasury bills for that month.
Mm-hmm. Exactly. Yep.
I still don't know why this doesn't just say that craft years are more likely to have any individual month be negative.
What's that, sorry?
You've got a year that's got overall negative returns, you're going to be more likely to have any particular month in that year show negative returns in January than month in that year.
We're talking about January predicting the next 11 months of the year. We're not including January in that prediction period.
Okay, and then change it again to February and the 11 months going forward.
Yep, and that's exactly what we look at on the next slide. Yeah. So does February predict the next 11 months? Yeah, exactly. So what we do is we say is there a statistically significant difference? We do that with 3 techniques, just a basic OLS technique, NW is just Newey West, and then the bootstrapping technique. We apply a bootstrapping technique which attempts to take account of the fact that, well, January is just one potential barometer. Actually, there's 11 others, so we need to dampen down our statistics on the basis that this just could simply be due to chance. So
By bootstrapping, you mean you randomize the residuals?
That's right, yeah. This bootstrapping technique is the one used by the authors in that JFE paper, so we follow their technique precisely. We actually think that there's a better technique to apply, so we apply that subsequent in the paper. This is just basically proving that our results are very similar to theirs, so we're not doing anything different before we build on their work. So getting to the point I think you were making, Eric, what we show here is the 11-month spread, so the difference between positive and negative 11 months returns for each month of the year. So that 19.15 is not quite the same as this 19.73 because although our data goes 1940 to 2006, we can calculate a January barometer in 2006 because we've still got the 11 months but we can't calculate a February barometer, so we just cut it off at 2005 to be fair. But what this hopefully shows is that there does seem to be something unique about January. I mean, the 11-month spreads following January, 19.15% with the equally weighted index 14. Nothing else gets close. Certainly, nothing else is close to being significant. Okay, in the more recent period, there is something in April that seems strange, but certainly for the data that we've got, the longest time period for January does seem to stand out.
These results are not calculated over the same time period?
These results for the EW and V.
No, this screen.
Okay.
You're not holding the time period constant?
For the first two series we are, that's 1940 to 2005. The last series is 1970 to 2005. So it's just basically saying a more recent period.
We'll blame the April 12th and 72 there on your deviation from CRISP.
Yeah, the reason that we used this more recent period, 1970 to 2005 or 6, is for comparison purposes with our international results, because unfortunately we don't have any CRISP internationally. So we need to go to another data source, and we thought, okay, why don't we bring the US results onto an equivalent basis with those. Okay, so these are the international results. As I said, these are 1970 to 2006, where that length of data is available. So that's 37 observations. For some countries, for instance, Greece, it's not much good data. We've only got five years there, so we probably should just delete that result from the analysis altogether. What we see in this period is that none of the p-values are statistically significant. So nothing holds up statistically internationally from these countries. Now, some of the spreads are in the right direction, and some of them are quite large, but we can't rule out the fact that there's just outliers driving those, volatility in the process. Certainly the p-values indicate that is the case.
The spread is pretty big, Finland.
That's true. Yep. There is a massive outlier in that. Yep. So out of the international countries that we consider, there seems to be something in Spain. By something I'm saying where we see a situation where all the p-values from the different techniques are at least statistically significant at the 10% level. There seems to be something in Switzerland, and unsurprisingly we see something in the MSCI World Index. The MSCI Global Index is dominated by the US. Pardon?
There's almost nothing there outside the U.S., but the planetary index, you're never at the 5% level, much less at the 1% level. The U.S. distorts the findings for the whole planet.
Yep.
I would say throughout the world.
You've got lots of big positive numbers. Even without the US, you just do the rest of the world. You've got so many positive numbers, just with the whole world, you're getting enough observation.
Yeah, just sort of stack it up. Yeah. Yep. That's a good suggestion, and that's something that.
Do you do an F test for all of them?
No. No, we haven't yet, but I mean, we need to do that, I agree. Yep.
Have you done February, March, the 8th, and so on?
Yep. Yep, I have. Yep. Unfortunately, I didn't bring them all over into PowerPoint, but I can show you them in the paper. I'm not sure whether that just looks like a mess of numbers that you can't see much of. Yeah, it does really. I'm sorry. What it basically shows is, I'm not sure if you can even make out the bold numbers, but you can see February sort of works better internationally than January.
So would you say that, roughly speaking, you take the number of countries you've got multiplied by 12, that's a lot of different tests, and approximately 10% of the time you achieve significance of 10%?
Yeah, you probably wouldn't be too far out. Yep.
And 5% of the time.
Yep. So the overall conclusion at this point is that it's seeming pretty dubious in the US, at least, unless we can find a good reason why it does work in the US. It certainly doesn't seem to work internationally. So what's going on in the US, I suppose, is where we go to from here.
Well, I don't want to steal this point from the honors we mentioned this to you, but this is a good time to talk about that. I mean, you do find great consistency. I mean, that the whole column are all positive there.
Mm-hmm.
You know, so, and you've got very small sample sizes, so to base a conclusion on the small, that's a standard error problem, probably.
Mm-hmm.
So,
Yeah.
that's why that test would overall be huge.
One of the things that we're doing to address this, to start with, we wanted to just limit ourselves to total return data, so we could include both the price movements and dividends for consistency with the US. But clearly, to do that, the total return series are too.
These results don't include dividends?
Yeah, they do. Yeah, this is all total return data. So to do that, we sacrifice sample sizes. We can get longer price series. So we think, well, why not supplement the analysis by using the longer price series from 1940 on internationally? And we find, at least our preliminary results show, that it's not like the world, all the other international markets all of a sudden show up with a January barometer. There still doesn't seem to be anything internationally once we address the sample size issue that's so prevalent here.
Have you combined them all, the rest of the world?
No, and that's something.
Because then the significance.
Yep, some sort of pooled regression. Yeah, I agree. That's another good suggestion. Okay, so I'm thinking I don't want to miss the better slides at the end. Do you have any opposition to me skipping a few? Because we finish at 4:15, right, Bob?
4:30.
Oh, 4:30. Yeah. Oh, okay, we've got plenty of time. Okay. I'm sure there's people in this room that know a lot more about stochastic dominance tests than I do. My co-author's the expert in this area. But what we're basically trying to say is, the first null hypothesis being, does a positive January barometer dominate a does a positive January return dominate a negative January return in terms of predicting a positive 11-month return? So the question is, can we reject that null? Are positive Januaries better at predicting positive 11-month returns than negative Januaries? And we can't reject that null hypothesis in the US. The other aspect to the stochastic dominance test is, can we reject the null that negative January returns are better at predicting positive 11-month returns than positive Januaries are? And we can reject that null very strongly. So basically, from this slide, I can conclude that the US result survives the stochastic dominance test. There does seem to be something in the US that isn't accounted for based on stochastic dominance. Unsurprisingly, given that we didn't really find anything in the basic tests internationally, they don't pass, except for Spain and Switzerland still do, and Norway shows up all of a sudden. So dummy variable persistence. So the theory behind the initial paper in this area was that if you've got a persistent dummy variable, it can lead to spurious inferences about the significance levels that you're showing. So that could well be an incorrect assumption to make. If we apply that methodology, however, that basically, through a bootstrapping simulation technique, expands out your critical bounds that you need to be outside of to still see significance. So it expands out the critical levels for not only the t-statistic, but also the coefficients themselves. There's two aspects to this test. One is just accounting for the spurious nature of the persistent dummy variable. That's just the first line. The other one also accounts for the fact that data mining bias could be occurring here. And this data mining bias adjustment just dovetails into the Bonferroni adjustment. So what it's basically saying here is January barometer is just one of 12 possibilities. So we need to have a Bonferroni factor of 12, if you like, and include this in the technique as well. Now, again, the numbers probably don't show up that well, but I've highlighted in bold the numbers that are outside both the spurious regression due to dummy persistence and the spurious regression due to data mining, outside both of those bounds. So for instance, value weighted, we get a T of 3.26. That is outside the bounds that we get after adjusting for both of those. So my conclusion on this slide is that 3 of the 6 series, we still see a January barometer effect showing up that can't be explained by this statistical issue here. So 1, 2, 3, all outside the bounds. So although we have a highly persistent dummy variable, for instance, from 1982 to 2005, there was a run of 20 years in a row that all had a positive January return. So the January barometer dummy is 20 consecutive times. Although we have that in our data, it doesn't seem to be the explanation, even if you buy into the fact that there needs to be an adjustment made. For the shorter series from 1970 on, however, that adjustment, which is very harsh, it basically shoots it down. The international results, well, the international results are only from 1970 on, so the 3 markets where we did see something internationally don't hold to this test here. Okay, so let's just recap. Basically what I'm suggesting is that there doesn't seem to be anything internationally. The remainder of this paper is just spent focusing on what is seen in the US. Is this a legitimate result in the US, or is it just an artifact of the data that's not showing up with some of the more traditional tests? The next thing we consider is time varying risk premia. So many papers have shown that fluctuations in risk due to the business cycle actually explain a lot of effects that we see in the finance literature. So one way to account for business cycle fluctuations or time varying risk premia is to include some business cycle variables. So things like the default spread, the term spread of interest rates, so long interest rates minus short interest rates, dividend yields, and so on. We could include all those in a regression control for those that way. But Bill Swert came up with another approach, which he suggests is a more definitive approach to addressing these issues. And basically his approach rests on the notion that if returns, you can say that returns, or that the predictability isn't due to time varying risk premia if you can predict negative excess returns. If the particular anomaly that you're documenting predicts negative excess returns, then predicting negative excess returns can't be due to risk. Any prediction of positive returns could always just be due to risk. But if you just strip out the positive aspect of the prediction and just say, can it predict negative excess returns, that's a way of assessing whether time varying risk premia is an explanation or not. So it's a bit of I suppose it's another model-free approach, isn't it? Rather than controlling for all these different variables which may or may not be good proxies for time varying risk premia, why not just take this approach? So we've done that. Basically, we just focus on the years where there's a negative January, and we say, how good is that negative January at predicting negative 11 months for the remainder of the year? Can it do that? If it can, then we can go some way to ruling out a risk-based explanation. Well, again, sample size is a big issue here, so it's possible that we can't make any good conclusions based on this slide. We do normal parametric analysis on means, and then we do some non-parametric analysis on medians to try and go some way to account for outliers and so on. Basically, based on the equal weighted index, we see that on average returns following a negative January, 11 months returns are negative, as the January barometer would suggest, negative 2.65, but we can't rule out, we can't reject the null that they're no different to 0. So we can't reject the null for the value weighted index based on either means or medians. For the equally weighted index, we can't reject at 5%, we can reject at 10%. So based on this slide, I conclude time variant risk premium explanation inconclusive. We can't say a hang of a lot given the limitations in our data.
The main difference between evaluated and equal weighted is the weighting given to small firms.
Yep.
Okay? There's more of a story if you enhance the importance of small
Yeah,
firms.
and that's where I'm coming to. I totally agree. I think you've reached the conclusion right at the outset. That's a big part of the explanation in my view. Okay, so just to bring this to a bit of a close, I suppose, we look at individual stocks and the size of individual stocks and how that might explain things. Now, we know that proponents of the January Barometer are talking about an index effect. They're saying as January goes for the market, so the next 11 months will go for the market. They're talking about things at market level. What I'm saying is, it doesn't seem to me to be unrealistic to expect a similar pattern to be in individual stocks that comprise the market. In other words, if we saw something that only existed at the market level and wasn't reflected in individual stocks, it would seem slightly strange to me. This is just a stylized example of how what's happening in individual stocks doesn't necessarily reconcile with the January Barometer. So in this first instance here, in this stylized example, 4 different stocks comprising the market. Well, stock 1, we would say the January Barometer was correct for stock 1, wouldn't we? Stock 2, January Barometer correct. Stocks 3 and 4, January Barometer correct. So January Barometer is correct for all individual stocks. If we just looked at an equally weighted index of those 4 stocks, the January Barometer is correct at the market level, isn't it? So if we saw this scenario in individual stocks, we'd say, well, this is quite compelling. There seems to be something pervasive in the market about the ability of January to predict the next 11 months. It shows up in individual stocks. Now, realistically, we're not going to see it working for 100% of the stocks, but we would expect it to work for a good number of them. Just to show, we can also see a scenario where the January Barometer works for no individual stocks. So in this case, stock 1, January returned 4%, next 11 months return -3%. So January Barometer wrong.
Are those just raw returns?
Yes.
So you don't have any portfolio diversification adjustment?
No.
Because obviously...
Not in the stylized example, no. Yeah. So stock 2, January Barometer is wrong again. The signs are different. Stocks 3 and 4. So the January Barometer in this instance was wrong for every single individual stock, but it still showed up at the index level due to the averaging process. And clearly, if the 2 extremes work, a 50-50 scenario works. So the next question is, what do we see in the CRISP data? Do we see something closer to this scenario, or do we see something closer to this scenario? What this graph here plots is the 11-month returns for stocks that were positive in January in the white bars, and the 11-month returns for stocks that were negative in January in the black bars. So let's just take this example here. I think that's 1946. We see that the stocks, it was a great year, 1946, for the stock market. The stocks that were positive in January put on about 50% in the next 11 months of the year, but the stocks that were negative in January actually put on 60%. So those that were worse in January actually did better. Now, what you see for this entire data is that 53% of the time, stocks that were worse and stocks that were negative in January actually outperformed stocks that were positive in January. So quite a strange result to me anyway. It seems to be that there's something at the index level, but it's certainly not driven by the stocks that you would expect. So let's just look at this a little bit more formally. What we do is just consider all years in the sample, and we say, okay, what's the mean positive return for the mean positive 11-month return for stocks that were positive in January across all years in the sample? And that's 7.42%. The mean 11-month return for all the stocks in the US market that were negative in January is 6.52. Is there a statistically significant difference between those two? No, there's not. So basically there's no evidence that stocks that are positive in January outperform those stocks that were negative in January. We do that for all years. We then look at some subsamples. So how about if we just look at years where there was a positive market return? Again, no statistically significant difference. Years where there's a negative market return, no statistically significant difference. Just to check we're not missing anything, we look at the same thing for medians, and again, nothing. If you look at medians, if you strip out potential outliers, you see that the median 11-month return for stocks that were positive in January for the entire sample is actually less. So we see this thing at the index level, doesn't seem to work for individual stocks. So some conclusions. Do positive or negative equity market returns in January predict positive or negative equity market returns in the following months of the year? Well, we say no. We don't think this January barometer is a reliable predictor. What evidence do we have to support that? Well, it doesn't work in international markets. Its success in the US isn't fully explained by dummy variable persistence or by data mining biases or whatever. We can't rule out time varying risk premia, but the big clincher for us is the fact that there doesn't seem to be anything in individual stocks that reconciles with what we see at the market level. So there doesn't seem to be any pervasive phenomena there. Now, getting back to the point about size, because I think this is a big explanation. It's something that I've just been thinking about in the last week. We know that the 11-month expected returns for markets tends to be positive. Stock markets tend to go up over time, don't they? So in this particular instance, 54 out of the 67 years we had a positive 11-month return. Unsurprising. If we want a barometer to work, we need a month that is positive more often than not, don't we? Because clearly the 11-month returns are positive more often than not. So we need a month to predict those 11-month returns that are positive more often than not. Now, what do we know about January? Well, we know that January is a month that on average is more likely to be positive, and the returns in January are likely to be higher than the remaining months of the year. Why is that? Why is there the so-called January effect? Well, we don't know the full explanation for it, but it does seem as if the year end, the financial year end in the US has something to do with it. At least one explanation that has been put forward is tax loss selling. The theory being that investors sell stocks that are recording a loss in December.
We have to mention to everybody in the room, unlike New Zealand, realized capital gains on stocks are taxable in the United States. That's it.
Sorry.
Kiwis should see me privately later about what just capital taxation of capital, realized capital gains is anathema to the national NBR readership and to even Michael Cullen's afraid of doing it. It is the norm around the North Atlantic.
Yep. That's certainly true. So the theory is that people sell their losing stocks in December. They've got a capital loss. They claim a loss from the IRS, I think it is in the US, and offset that against their other income. So they realise that loss, but then they think, well, actually, we want to hold these stocks. We want to be in the market going forward, so we'll buy these stocks back in January. So whether that's a compelling explanation or not, I don't know. I think it's got some flaws. But the fact is that we do know beyond doubt that January is a very good month for the stock market on average. January is far more likely to be positive than other months.
They have to buy them back in January, those same ones. Why not just take their tax losses and then just start their position again? I mean, not necessarily in the same month.
Okay. Yep. Oh, that's a good point. Yeah. No, that's a better explanation. They just put their money back in the equity market somewhere else. Yep. I agree.
But if I'm some large pension fund that's investing for my clients, I don't really care so much about that, do I? Because they don't pay taxes directly.
Yeah.
And so if I knew they had this January effect, I just go ahead and arbitrage it, take advantage of it. Right?
Yeah.
So that's not. I can't. Yeah, that's what I'm thinking. Yeah.
So I agree with you. We don't know why January returns seem to be so good. This is one explanation that's been put forward. I agree. I think it's a bit of a feeble explanation, but tax loss selling is.
But all it takes is money at the margin, and not people at the margin to make the difference.
Yeah.
The individual investors at the margin.
Yeah.
Yep. So, but I'm not sort of debating that tax loss argument so much. All I'm suggesting is that the fact that January returns are the very returns that seem to be positive for some particular reason. I don't think we don't know the reason. That in itself suggests that January could be a good month for predicting 11-month returns. We know 11-month returns are more likely to be positive than negative. So there's not necessarily any causality between the two. It just so happens that we see the January barometer working because of the fact that we know that January tends to be a good month. Sorry, Bob.
Different points. I want to show up this point, but you seem to suggest that because it wasn't valid at the individual stock level, it somehow has less. It should be less bothersome in some sense at the market level. But again, since you can buy an S&P mutual fund, then who cares? Who cares whether it's valid at the individual stock level or not? There's still this, $50 bill sitting on the sidewalk that people are walking by every day and aren't picking up, and that doesn't make it any less bothersome or more bothersome that it's not true at the individual stock level.
Yeah, I suppose if it was true at the individual stock level, it would give us a bit more confidence, and it would suggest that maybe there's some sort of behavioural bias or something that was driving this. For instance, one of the explanations that's been put forward for the January barometer is that major institutions, pension funds and the like, tend to make their decisions for the year at the February meeting. They often don't meet in January because everybody's away on holiday. So maybe they use the January return. What's that, sorry?
Not in the US, it's not quite the January holiday effect.
Okay, yeah, which just shoots down this argument even more. But one of the attempts to try and explain the January barometer, which I don't happen to buy, is that investment committees meet in February. Their reference point at that point is how their assets and so on have done in January. So if January's been a good month for stocks, they're bullish on stocks for the remainder of the year. But getting back to your point, Bob, about the relationship between what shows up in individual stocks versus the index level, I think the fact that nothing shows at individual stocks is at least a little bit disconcerting from a behavioural bias point of view. I mean, if you think of momentum in stock returns, there's been literature that shows that there's a gradual information diffusion process. Maybe people don't react to information as quickly as they should, and maybe that goes at least some way to explaining why there is this momentum effect. I think we can sort of rule out any sort of behavioural bias, because why would it not be showing at individual stock level if people used January? But it doesn't rule out an institutional reason, for instance.
But does any rational investor just hold individual stocks? They're always going to hold them in the context of a portfolio. So looking at just the individual stocks wouldn't seem to be a good measure, because nobody's, well, I mean, I know people are, but for the most part, a rational investor doesn't hold an individual stock. And so therefore the risk measures and such. And therefore the return measures. So
I suppose in terms of an individual stock analysis, I mean, we're just dividing the market into two segments. Like, we've got two portfolios of individual stocks that we're comparing, aren't we? Right. So 10,000 stocks is 5,000. Well, yeah.
I'm not sure if I your January is a good month, so that could be the one that works.
Okay. Yeah.
That wouldn't explain why negative January is correlated.
Exactly. Yeah. Yeah.
Given that it's just a sort of plus.
Yep. Yep. Yeah, I mean, one explanation I had, sorry to butt in, one thing I was thinking was that we do know there is this pervasive bear markets from time to time, where pretty much every month is negative, for 3 years at a stretch. So there's going to be a bit of noise around that, but it's not unlikely that January could be negative and then you could have a negative 11-month return. So given that we don't see many instances of a negative January, perhaps that's just, happens to be part of a bear market move.
A couple of questions. One was that given this lack of reporting on what's happening in the stocks, I mean, how frequently does the basket change? Could there be an exiting firms effect on small firms go belly up and taken out, and that somehow there's an identifiable bias in what's going to happen in the index, that, which would then have to be correlated with firms go belly up in December or January or something.
Yeah.
But I mean, but if there's something about the changing competition that explains the disconnect between individuals.
How often do they re-weight the 500?
Well, this.
About once a year.
Yeah, that's the 500. But what we're doing is all stocks in the market, right? So CRISP is the market. Yeah. And I think this is the point is a very good one, because see, what we see here is equally weighted returns following a negative January are negative, like as the January Barometer would suggest. But the value weighted aren't, are they? So clearly there's a small stock thing, like the only difference is the weighting given to small stocks. So it's working better for small stocks, and it's the small stocks that drive the other January effect. We know that the market tends to do well in January on average, but small stocks do particularly well in January.
Small stocks do particularly well.
Yeah,
Period.
that's true, but at least the evidence that I've seen suggests that this is incremental outperformance in January.
The January effect is driven by the bottom side.
Yep. I think that's pretty well established. I agree. Yep.
Another question is, how does the January Barometer prediction for the number of months for the period 67 through to now be the Super Bowl, which is the famous one, which is that if the NFC wins, the market goes up. If the AFC wins, the market goes down. Which apparently was an extreme, or at least it was up until the 90s, extremely reliable, largely because the AFC kicked ass because the Steelers in the 70s, the markets were collapsing, and the NFC won everything.
But the quote there from when the Hurst went 74, that said 20 of the last 24 years that preceded the Super Bowl.
Because one of your data only comes from sort of more recent.
It's always a dilemma. I mean, I'd be interested in your feedback in terms of the tension between having sufficient data to make valid statistical inferences, but having data that's not redundant because it's so historical. And one of the problems with this analysis is that you only get one data point per year. So if you just look at 1970 onwards, yes, it's a more relevant period, but yes, we're losing a lot of observations. So.
If the Super Bowl measure is continuing to work as well as it used to work, and it's so obviously spurious by its very nature, unless you really believe aggressive testosterone charged potential traders who are NFC, not AFC fans because they're old-style football fans, then it is so utterly spurious. And if it does even better than the January Barometer, that's just another reason.
No, it's a good point. Yep. I thought, like, I'd need to have a look at the literature, but I thought that had been, the Super Bowl effect had been well and truly sort of dismissed.
Well, as I said, I'm seeing the other day.
No, I'm not.
The started winning again recently.
The problem with tax loss selling is that there's no abnormal negative returns in December. Okay? If there's set, because there has to be a period of selling. For by the market close on December 31st. Because almost all individuals are taxed on American individuals are taxed on calendar year. Okay, so you got to realize your losses by New Year's Eve. Okay. Now there seems to be this surge in the market in January. Okay. Now there's another explanation. It's money flows. Okay. The investment in tax deferred portfolios, you are limited in how many dollars you can invest per year, an IRA or a 401k plan, and so on. So money is bunched up in the autumn and the early winter, champing at the bit to cross the January 1st finish line. Was that?
You can do that up to April 15th.
The point is, that's irrelevant.
I don't know. I think maybe biased too. I thought it was a pretty good one.
Imagine a parallel universe where you're not married to her. Now, go visit that universe.
So many things like you said. So many things like you said.
The point is, a lot of money, checks go into mail around New Year's Day.
Right.
But again, that explains those particular class of investors. It doesn't explain the other investors who aren't working on the same kind of.
I'm saying the tax deferred investors.
Well, I think that's a very good point.
With the exception for people who have inherited a large chunk of stock because some ancestor started a Fortune 500 firm. Set those aside. The individual investors in the U.S. are through tax deferred portfolios, and that's the main source of money flows from the household sector into the stock market is investors for retirement.
Yeah, I think the point about the tax loss selling explanation not holding up internationally is a very good one, because the tax loss selling doesn't, we don't see an April effect in countries that have a March year end that have capital gains and capital loss. So it's a weak.
Notice 25 years ago, the tax year in the UK begins on May 1st.
Mm-hmm.
There is no May effect. And likewise, realize that you realize capital gains are taxable, and realized losses offset realized gains. Broad brush, equivalently to the U.S. But the tax year is radically different. It begins May 1st instead of January 1st. And you don't see this amazing May effect or an April effect in the London Stock Exchange.
Mm-hmm.
And I don't want to keep scaling this point that the honor student made, but like
no, it's fine.
keep saying there's no effect internationally. That's not true.
Yep.
That's accepting the null hypothesis is equal to zero.
Mm-hmm.
So what you actually do get a positive January effect. It's actually pretty large. It's just not significant.
Yeah.
And so you don't know what the overall p-value is. You know it's going to be a lot less than those p-values you have up there. You know that. And so it's very possible you have p-values. Even if it's still insignificant, you might have p-values in the 15% range. That's still it still would be a small enough p-value for me to say, not feel comfortable saying the effect is zero. Right? So I think you got to be careful by just, and I mean, again, it's not my point, but somebody else's point, but I just think that's, we've said it several times now, there's no international effect that we can be careful of.
Yep. No, that's a fair point. I need to present the analysis that dates back to 1940 to prove to you. Yeah, to prove to you. Yeah, I agree. I think one of the problems with that paper is it's actually overstated on a number of fronts, that particular version. I totally agree. Yep, it's a very fair point.
Well, the only
yeah.
one might hear about Canada is that I don't know if it's just for Phil's point, because they also have a huge flows going to text good. So we pay for some structure RFPs. And I don't know that their structure exists in the other countries.
It's at their fiscal year in December 31st.
So there's Canada there.
I think so.
Tax year for households.
How are they earning money there? I'm pretty sure.
I think it was different for firms than households, but I might be wrong. It's been
Yeah.
Firms can choose fiscal years almost at will in the U.S. in corporation.
I think it might be the same in Canada.
But household.
I know you pretty much fill out your bloody tax forms in the US and roughly 2 weeks apart.
I suppose, Bob, just going back to your point, I'd be interested in your comments on the true out-of-sample nature of these international tests, because I would say that due to the strong correlations that there are between markets internationally, that by default you would expect something that existed in the US to show up internationally to a small degree, not because there's necessarily any following from it internationally, but simply just due to the correlations that exist. So
because markets are connected.
Yeah, exactly.
It doesn't seem to change the fact. I mean, at the end of the day, from an investor, who cares why?
Yeah.
January the next 11 months. You know, maybe it's because the U.S. market. It works in the U.S. market that spilled over. But who cares? The fact of the matter is, I can make money in Hong Kong, whatever it's called, or the Shenzhen market, because that's what I observe.
Yeah, it's a good point. Yep. And I mean, and the point is that even if we had very strong statistical significance, it doesn't actually give a good indication of what's going to happen next year or the next 2 years. For instance, the January Barometer hasn't worked for subsequent years in the US over time. So there's always. I'd need to check that, because it's one of the things of how much data you include to get significance.
I would love to see you do something where you've got these financial instruments come along that lower the transactions costs and taking advantage of this. And you can't do that with that MSCI thing, which you can do, because that's not long enough, but you can with the other ones. I mean, if there ought to be some effect. I just buy a mutual fund.
You can't buy the equally weighted.
Okay, but for the...
You could do it for the S&P 500, right? Just the underlying
S&P
instrument
500
of the ETF.
Closely correlated with BW.
Yep.
Who cares? But the point
Yep.
is, it's an instrument.
Yeah.
Of course, but the thing is, it's an instrument you can buy. You can buy it as a single transaction.
Yes.
And so, and if that, I mean, if you truly can make money on that with consistency, that doesn't.
Because there was no January effect for that, was it? It wasn't for the
Valuation?
yeah. There was, but it wasn't. Negative January returns were predicted, wasn't.
Well, that was just looking at the negative.
Those that were negative in January still.
Yeah, I think that's, yeah.
Yep. But I think that's a big part of the effect. Like, you'd expect it to be able to predict negatively because we know that markets go up over time.
Right.
We know that we've got a month that, for whatever reason, tends to be positive in January.
Right.
So it's not a complete surprise that you see that number there.
Right, exactly.
So it's that number there that's quite critical. I believe anyway to the predictability.
You want to go before markets go over time because it's a return. It's what you get minus what you get in one market.
Right.
So it is negative.
Yeah.
Negative.
Yep. In the excess return space, that's correct. Yep.
When was the January Barometer first made?
The quote that I included is the first time it was publicised, to the best of my knowledge. That was 1974, I think. Yeah, so we haven't been too precise on that. The 1970 sort of start point sort of did that a little bit. Yeah. Yes.
The first academic to notice the peculiarities of stock returns in January using this monthly data set was Ralph Bonds'.
Yep, 81 was it?
Yeah.
Yep.
No, it published in 81. We didn't say.
Okay. Yep. The famous size effect. Yep.
Any other comments or
Okay.
questions? I think you'll agree with it. It was a great seminar.
Thank you. Thank you for your comments, and thank you again for inviting me down here.